4.3%. And also the lingering effects of heightened trade tariffs will continue to impact the US economy. So real GDP growth is projected to decelerate to around 1.2% year over year in Q4. And full year 2025 GDP growth is projected to be between 1.7% and 1.9%, in line with the Federal Reserve's projection of around 1.8% for the full year 2025, with tariffs trimming growth by up to 0.5 percentage points in the second half. And also, as consumer spending cools, PCE, personal consumption expenditures, are expected to expand at just 1.2% for the full year, and business investment faces headwinds from policy uncertainty and elevated interest rates. Okay, so our view is that the Federal Reserve is currently facing a dilemma between economic slowdown on the one hand, which requires more rate cuts, and sticky inflation on the other hand, which may require higher interest rate for longer, necessitating high interest rates. Okay, Trump's tariff and tax cut policies will further complicate this balance, forcing the Fed to adopt a cautious wait-and-see strategy, keeping interest rates elevated for longer, higher for longer. And the current shutdown, US government shutdown, will also add to this wait-and-see strategy to be adopted by the Fed, because a lot of major key economic data will be delayed. For instance, the non-farm payroll, as well as the consumer price data, inflation data, to be released next week, will certainly be delayed to further. Okay, but based on the FOMC minutes released last night, it seems that most officials prefer a further cut in October. So the market is expecting another rate cut of 25 basis points end of this month. The key triggers for future rate cuts would be either inflation falling close to 2%, closer to the Fed's target, or a significant rise in unemployment exceeding 4.5%, which we think the probability, the chance for the latter to happen, that means unemployment rate rising further to 4.5% or above, is more likely than inflation falling close to 2%. Okay, on China's economy, we expect China's economy to enter Q4 with momentum from Q3 stimulus measures. So since the beginning of this year, the Chinese government has implemented quite many stimulus measures to support the economy. Yet, the China's economy will face structural challenges which is not easy to resolve, such as weak domestic demand, deflationary risk because of oversupply in many industries, the property sector crisis, and also external trade pressures. GDP growth for 2025 is expected to moderate to 4.7% as export front-loading fades and consumption remains lackluster. Yet, if the Chinese government wishes to achieve its 5% growth target, we think it's still possible, because the target may be met through more policy tweaks, more stimulus policies to be announced. Okay, going forward, we believe the policy direction of the Chinese government is to prioritize increasing the share of consumption in GDP in the upcoming 15th five-year plan to address economic structural imbalances. Monetary policy focuses on stabilizing prices and promoting a shift from an investment-driven to a consumption-driven economy. It's more, the emphasis is more on the demand side rather than the supply side. Okay, we expect more interest rate cuts as well as reserve requirement ratio reductions before the end of this year as well as next year. So in 2024, looking backward, the People's Bank of China implemented 2 reserve requirement ratio RRR cuts totaling 1 percentage point and 2 interest rate cuts totaling 0.3 percentage points. So it's estimated that every half percentage point cut in the reserve requirement ratio will release liquidity of about 1 trillion yuan. Okay, so every half percentage point cut will release liquidity of 1 trillion yuan. So it will increase the capability, enhance the capability of commercial banks to lend out more to its customers, to consumers as well as enterprises, to stimulate the economy. Okay, and in May this year, the RRR was cut by 0.5 percentage points, and the policy rate was lower by 0.1 percentage points. So last year we had the PBOC had implemented 2 RRR cuts. This year so far only 1 RRR cut. So we do expect there may be another RRR cut before the end of the year, and also rate cuts also expected in the 4th quarter this year. Consumption stimulus will continue. Lately, the Chinese government has announced interest subsidies for service industry businesses and also consumer loans to boost consumption. In the past, the policy direction is to provide direct subsidies for consumers to buy, say for instance, electric vehicles or electronic products. Now, on top of this, the Chinese government has implemented new initiative by offering interest subsidies, 1% interest rate lower to service industry business and also consumer loan to consumers. Okay, so this is the latest move taken by the Chinese government to boost consumption by providing interest subsidies. And then China is shifting toward high value added industries such as EVs and also solar panels, while maintaining progress in AI, artificial intelligence. Okay, Hang Seng Index was up 34.4% year to date and up to 6th of October early this week. So the Hang Seng Index outperformed US and also many other major indexes in the world this year. We expect near-term resistance around 27,500 and key resistance will be 29,000. Okay, so that's our target, near-term target, and also mid-term target for the Hang Seng Index. As for near-term support, we expect there will be near-term support around 26,000. Actually, yesterday and today, the Hang Seng Index tested the 26,500 and found support there. So far, it managed to hold above 26,500. The near-term support will be further down, slightly further down, around 26,000, and key support is around 25,000. Okay, which is where below the 50-day moving average. The Hang Seng Tech Index, led by the tech companies and also the AI themes, was up 46.6% year to date. So it outperformed Hang Seng as well as the China Enterprise Index. Currently it's trading around 6,550 points. So we expect near-term resistance around 6,780. And the key resistance is the 7,000 psychological threshold, the 7,000 psychological threshold. Near-term support will be around 6,400, and key support is expected at 6,000 points. Okay. Just now we mentioned that Hong Kong stock outperformed many other markets, other stock markets. What are the key tailwinds, the key positive factors supporting the Hong Kong market? First of all, is attractive valuations. The Hang Seng Index trades at a forward PE ratio of around 10 times. Now is around 11 times after the rally so far this year. Still well below its 10-year historical average of 11.1 times, and significantly, if you compare to US, it's cheaper than US benchmarks like the S&P 500, which is trading above 22 times PE. Hence creating a value gap that funnels capital into Hong Kong stocks. Okay. We also see record southbound inflows via the Stock Connect, more mainland fund flow into Hong Kong. Southbound net inflows exceed 1 trillion Hong Kong dollars year to date in the up to September, surpassing the 2024 full year total of 807.9 billion Hong Kong dollars. And we expect this inflow to continue in the next at least 6 months. Chinese government stimulus and economic policies. China's accommodative monetary stance, contrasting US tightening earlier, includes interest rate cuts and RRR, reserve requirement ratio cuts, consumer trade-in subsidies, and fiscal measures targeting real estate stabilization and domestic demand. Okay, the other positive factor, which is has a big impetus on the Hong Kong market lately, is the AI story. Okay, so tech stock sector boom led by AI and innovation is reflected in the rise in the Hang Seng Index this year, outperforming the Nasdaq, driven by breakthroughs in AI, large language models, LLM, and digital innovation from giants like Alibaba, Tencent, Baidu, and Kuaishou. Okay, and also we are seeing easing Sino-US trade tensions. Talks in Geneva and London yielded a framework for resolving disputes over unfair practices, excess capacity, and fentanyl. On December 19th, last month, President Trump and Xi Jinping held a call. So Trump will meet Xi. If Xi will visit Korea later this month, they're expected to meet at the APEC on the fringe of the APEC summit, and potentially yielding further tariff adjustments, and also paving the way for Trump visit to China next year. Okay, so these are the positive factors supporting the Hong Kong market. Okay, this chart gives you a better idea of the southbound fund flow. You can see the green chart represents inflow, net inflow into Hong Kong from mainland China capital. The red bar represents the net outflow. So since April this year, for the last 5 months or so, you can see the number of days with inflow, net inflow, outnumber those days with net outflow. And lately, the net inflow remains stable between 5 billion Hong Kong dollars to 10 billion Hong Kong dollars a day. You can imagine with 5 billion to 10 billion Hong Kong dollars coming from China into the Hong Kong market every day. So this is a very strong support for the Hong Kong market. Okay. In view, however, admittedly, there are still a lot of uncertainties, a lot of headwinds, such as geopolitical tensions and the tariff rate between US and China has actually not been fixed yet, not until November. So in view of the ongoing uncertainty and also market volatility, we recommend return and growth strategy as illustrated in this chart. We recommend a three-pronged investment approach, comprising the blue one, AI, tech stocks, tech companies that will benefit from artificial intelligence technology breakthrough. So we recommend investing in the technology sector to capture growth potential in AI. And then as global volatility intensifies, high dividend stocks will offer stable income and defensiveness. So we recommend the strategy of both return and growth stocks. Okay, and as US is expected to cut interest rate by maybe at most 1 percentage points up to mid-June next year, there'll be more US interest rate cuts. So we also think investing in US bond, US Treasury, or US MMF, US dollar MMF, will also provide stable income to investors. So we recommend this three-pronged investment strategy, comprising return and growth stocks. Okay, in both tech stocks as well as dividend stocks, I think Hong Kong and China, the Hong Kong and China market will offer attractive return. You can see on this chart on the left-hand side, China tech stocks are expected to generate close to 25% rate of return, investment return, okay, in the next 12 months. And also compared to around 16% from US tech companies. Okay, and high dividend stocks in China and Hong Kong are now yielding more than 6% dividend yield, compared to between 4 and 5% from US Treasury, and also around 3% from US dollar money market fund. So I think in investors' portfolio, China tech stocks as well as high dividend stocks are recommended, okay, for the next 12 months. Okay. On the return strategy, if you don't wish to pick individual stocks, we actually recommend this Hang Seng High Dividend Yield Index ETF. Okay, so let's focus on this high dividend yield index. It's well positioned to benefit from increasing allocation from global investors amid global market volatility and the potential dividend tax removal for southbound investors. Notably, this index consists of over 55% of its constituents in state-owned enterprises, Chinese SOEs. So those SOEs are more stable in terms of financial results and also in terms of a dividend payout. High dividend strategy is also a key beneficiary for China's forceful stimulus package and policy supports. People's Bank of China's 300 billion yuan relending facility should boost corporate buyback, and capital market 9 measures, 新国9条, issued by the central government, also promotes corporate dividend layout. Through investing in the Hang Seng High Dividend Yield Index, investors can gain exposure to high dividend paying and low volatility companies. Okay. So this index bit on the index methodology, how it picked the constituent stocks. First step is stocks are ranked by yield and adjusted for one-off special dividend. So it will make adjustment for companies that pay special dividend, which may push up the dividend yield. But this is not a long-term phenomenon. Okay, the second step is to screen out stocks that exhibit high volatility, and also stocks that plummeted by more than 50% will be screened out to avoid the value trap. Okay, cheap cheap valuation is not because of good profitability of the company, but because the share price has dropped so much that the valuation looks attractive. So this is the so-called value trap. Okay, and the last step is we'll choose among the eligible candidates the top 50 yielding companies. They are weighted by yield, subject to a 10% capping on single stock. Okay, this is a comparison of the Hang Seng High Dividend Yield Index with the Hang Seng Index and the Hang Seng China Enterprise Index. You can see in the last few years, okay, the blue line, which represents the Hang Seng High Dividend Index, clearly outperformed the Hang Seng Index as well as the China Enterprise Index, the CEI. In terms of total return, okay, from 2015 to 2024, the last 10 years, total return amounts to close to 180% for the high dividend yield index, compared to 67, around 68% return generated by the Hang Seng Index, and only 32.3% from the Hang Seng China Enterprise Index. So you can see this Hang Seng High Dividend Yield Index will generate excess returns, triple-digit excess returns when compared to Hang Seng Index and also Hang Seng China Enterprise Index. Okay, the Hang Seng Index represented by the orange line, the dividend yield is less than 4%, whereas the Hang Seng High Dividend Yield Index at a point in between 2021 and 2022 was as high as 10% dividend yield. Now, because the share price of the constituent of the index has risen, so the dividend yield moderate to around 6%, but 6% is still good if you compare to less than 4% dividend yield, average dividend yield of the Hang Seng Index. Okay, majority of return is sourced from dividend. This is the dividend earned by investors for from the Hang Seng High Dividend Yield Index. The total return comprise two parts, dividend and price appreciation. You can see that actually majority of the return is derived from dividend. Okay, these are the top 10 holdings of this ETF, Global X Hang Seng High Dividend Yield ETF. The stock code is 3110. Okay, it comprises Hong Kong companies as well as Chinese companies. Among the top 10 holdings, there are Hong Kong property developers, Hong Kong property investment companies such as Hang Lung and Hysan Development, which owns the Hysan shopping mall. Okay, and also some industrial companies like Yuyuan Industrial, VTech Holdings. Okay, the investment objective of this ETF is to provide investment results. So it's a passively managed ETF that tracks the performance of the Hang Seng High Dividend Yield Index. Okay, it's quite diversified in terms of sector exposure. You can see industrials account for around 22.6% of the ETF. Financials account for 17.1%, followed by real estate, energy, and utilities. Okay. As for geographical location, as I mentioned earlier, because there are some Hong Kong companies, so those companies with business in Hong Kong account for 34% of the ETF, and China companies account for the remaining 65%. Okay. So far this year, it was up 28.5%, slightly underperformed compared to the Hang Seng and Hang Seng Tech Index. Okay, so we expect good support around the 100-day moving average, which is around $27.50. Okay, so a recommended entry level, the nearest one will be $27.50. Okay, growth strategy, we also have ETF pick, which is the Global X China Core Tech ETF, stock code 3448. The rise of China's high-end technology, as supported by global competitiveness of China's tech companies, which continues to rise, they're expected to deliver good stock returns in the mid-long term. And the era of G2 technology has arrived, where technology companies from both countries here are referred to China and the US. They are competing directly and leading the world. And this ETF provides a diversification tool to investors with high exposure to US tech stocks. If you are already highly investing in US tech stocks, then I think it may be advisable to diversify, to have some diversification into Chinese tech companies. Okay, and you may ask, what's the difference between this China Core Tech ETF 3448 and more popular ETF tracking the Hang Seng Tech Index, such as 3033, the one managed by CSOP, China Southern Oriental Patron, CSOP, CSOP's ETF. This one differentiate from the Hang Seng Tech Index as large cap internet companies are excluded. The fund manager of the Global X launched this Core Tech ETF on the belief that a lot of the large cap internet companies are already well owned by many investors. So through exclusion of these companies, the ETF serves a diversification tool for investors' technology portfolio. And the portfolio also has better revenue, earning per share growth prospects with reasonable valuation. Okay. This is a comparison between the Hang Seng Tech Index and the Mirae Asset China Tech Top 30 Index, because the Global X Core Tech Index ETF actually tracks this Mirae Asset China Tech Top 30 Index. You can see for Hang Seng Tech Index is quite concentrated, quite heavily exposed to the internet sector, accounting for 56% of the index, whereas internet companies are excluded deliberately from the Mirae Asset China Tech Top 30 Index. So it ends up with a more diversified exposure, with 22% to electronic equipment, followed by 17% in semiconductors, and another 17% in solar, 15% in software. So it's more diversified. Okay. Index also offers A+H exposure. For the Hang Seng Tech Index, it's 100%. The constituent stocks are 100% companies listed in Hong Kong. But for this Mirae Asset China Tech Top 30 Index, 35% are companies that are listed in China. Okay, so you have exposure to both companies listed in Hong Kong as well as in China. You can see among the top 10 holdings, there are Shanghai listed companies as well as Shenzhen listed companies. Okay, so Contemporary Ebrix Technology, CATL, is among the top 10 holdings, followed by SMIC, Zhongxin Guoji, and Jiangsu Hengrui Pharmaceutical, okay, and Xiaomi, BYD. Okay, so the investment objective of this ETF 3448, which is also a passive ETF, is to provide investment results that before fees and expenses closely correspond to the performance of the Murray Asset China Tech Top 30 Index. Okay, in terms of sector exposure, 51.5% are exposed to the IT companies, 20.7% healthcare, 15.6% industrials, and 11.9% consumer discretionary. As for geographical location, all the companies are with Chinese business, Chinese operations. So this index was launched in July this year. So since launch, it was up 43.6%. The performance also not bad, outperforming the Hang Seng Index. So a good entry price would be around the 20-day moving average, which is around $124. $124. Okay. The other sector we are upbeat about is robotics and AI. Okay, robotics and AI. So robot density in China is expected to double by 2025 from 2018 and will grow further beyond 2025. Okay, and increasingly you can see that domestic makers of robot makers are gaining market share. In 2019, domestic makers only account for less than 30% of the total market. Yet in 2024 last year, it has outsized foreign companies accounting for 51% of the industrial robot market. Okay. A development plan by the State Council to bring core AI industries, to grow core AI industry size to 10,000 billion by 2030. Okay, so that will double the amount in 2025. Okay. And AI models have the potential to automate a large share of current works, enhancing companies' efficiency and also profitability. So mainland China, it is expected that AI will automate around 15% of current works. Okay, but of course, the US and Japan will see a higher replacement, a higher share. Okay. This ETF has two different counters. It has a US dollar counter. The stock code is 2807, and the US dollar counter with stock ticker 9807. So if you don't have US dollar, if you have US dollar with you, you can choose to the US dollar counter to invest in. So you won't suffer from exchange loss for converting your US dollar into Hong Kong dollar. Okay, so you can see that the top 10 companies, some are listed in Hong Kong, such as SenseTime, Shangtang. Some listed duly in Hong Kong and the US, such as Baidu, and also some are listed in Shanghai, some are in Shenzhen. Okay, And the investment objective of this ETF is to provide investment results that before fees and expenses closely correspond to the performance of the FactSet China Robotics and Artificial Intelligence Index. So it's also, this ETF is also a passive ETF tracking this FactSet China Robotics and Artificial Intelligence Index. Okay, sector exposure, IT companies account for close to 60% of the ETF of the AUM, industries accounting for 23.8%, and consumer discretionary accounting for 10.1%, followed by communication services 6.8%. Almost all the companies are operating in China. So China exposure is 99.8%. Okay. So far this year, this Global X China Robotics and AI ETF 2807 has risen close to 38% year to date until 6th of October. Okay. We reckon that two entry levels. One will be around $62. Okay, $62, and the another recommended entry level will be around $60 or below $60. Okay. IPO strategy, as you may have read in the news, that the Hong Kong IPO market is very active and robust lately, and actually Singapore investors can also participate in the IPO market by subscribing to the new shares. Okay, so if you want to find out more about the details, I understand that only AI accredited investors may be allowed to invest to apply for Hong Kong IPO. So if you want to find out more, you may contact your remisiers or trading representatives in Phillip. Okay. Hong Kong's IPO market is reclaiming world #1 position. So in the first 3 quarters this year, there were 66 new listings completed, 47% increase from the same period in 2024. And money raised amounts to 182.3 billion Hong Kong dollars, approximately 23.44 billion US dollars, were raised in Q1 to Q3, up 228% year over year. This includes 6 mega-sized IPOs. By mega-size, we refer to companies that raise over 10 billion Hong Kong dollars. So they account for a significant portion of the total. And Hong Kong EX top global IPO proceeds in first half, ahead of Nasdaq's 8.85 billion US dollar and NYSE 7.52 billion US dollar market cap, and maintained leadership through it's IPO proceeds, not market cap. This is the IPO proceeds in the first half by Nasdaq as well as NYSE. So Hong Kong EX is expected to maintain leadership through Q3 to Q4. Okay. The driving factors for the robust IPO market, there are quite many supporting factors, among which the A+H dual listing surge. Mainland Asia companies are increasingly pursuing secondary listings in Hong Kong to assess international capital, expand globally, and mitigate US regulatory risks. Example, potential delistings and under heightened US-China tensions. So they can always come back to Hong Kong for listing. In the first half, 7 A+H deals raised 77 billion Hong Kong dollars, 72% of the total proceeds, including 4 of the world's top 10 IPOs. As of June 44, A+H applications were pending, with 43 involving firms over 10 billion yuan in market cap. Another driving factor is policy support and regulatory tailwinds. Beijing's pro-growth measures, including support for leading Chinese enterprises to list overseas, have boosted confidence. Hong Kong EX initiatives such as the tech channel for AI, biotech, and specialist tech firms, and recent consultations on IPO price discovery. Example, minimum 40% book build allocation and new fund flow free float rules, enhanced flexibility and liquidity. New rules effective August 4th, 2025 kept initial public allocation at 5 to 10%, with clawbacks up to 35% for more than 100 times demand, oversubscribed demand. Intensifying ratios but stabilizing post-listing prices. That's what we're seeing now in the Hong Kong stock market. Okay, the Hong Kong government's 2025-26 budget emphasizes strengthening its role as a financial hub. Investor appetite and liquidity. High liquidity from southbound inflows, as I showed in the chart earlier, and North American pension funds. They are also interested in some Hong Kong stocks, and lately Middle Eastern sovereign wealth and European private equities are driving oversubscription, IPO oversubscription. 95% of 2025 IPOs are oversubscribed. Post-listing returns average over 30%, not bad, attracting retail and institutional investors. So sectors like AI, renewables, and digital consumption align with global trends, drawing funds amid a stable US dollar and Fed rate cuts. Okay. The Hong Kong IPO market has experienced a dramatic resurgence in 2025, reclaiming its top position as the world's leading destination for IPO fundraising. In the first 9 months of 2025, Hong Kong saw 66 IPOs, raising a total of $182.3 billion during the period. Compared to the same period last year, the number of IPOs rose by 47% from 45, while total fundings raised leaped by 228% from $55.6 billion. With Hong Kong is currently processing more than 230 active applications and potentially more than 5 mega IPOs, including A+H listing. Hong Kong is projected to see over 80 IPOs raising $250 million to $280 billion this year. So, yeah. A+H dual listings. Mainland Chinese firms are flocking to Hong Kong for secondary listings to fund globalization and diversify funding sources. 8 A+H deals in the first half alone raised over $78 billion, because most of these A shares, they are state-owned enterprise or big, very, very big companies. So when they come to get a listing in Hong Kong, they also managed to raise a lot of money. Okay, so the world's largest EV battery maker, CATL, contemporary Amperex technology, was listed this year in May, between May and June, with 41 billion Hong Kong dollar, equivalent to 5.3 billion US dollars, the biggest global IPO of first half and Hong Kong's largest since 2021. Okay. More policy support and reforms from the authority. Beijing's push for leading enterprises to list in Hong Kong, combined with Hong Kong EX initiatives like the Chapter 18C to allow companies with no profit or even no revenue to get listed under Chapter 18C for specialist tech listings. Now Hong Kong boasts 73 biotech firms. A lot of biotech companies are being listed in Hong Kong, so there are a lot of choices. and has broadened appeal to investors. Recent Hong Kong EX consultations concluded August 2025 introduced enhancements to IPO price discovery, including a 40% minimum book bill allocation and new public subscription mechanisms to boost liquidity and retail participation. Last but not least, investor diversity. So more North American pension funds, Middle Eastern sovereign wealth, example, Cornerstone Investments in CATL and insurer FWD Group benefit from more fund flows from North America pension funds and Middle East sovereign wealth. And also European private equity have driven engagement. And retail oversubscription in several deals highlights strong local enthusiasm. Now easily you see oversubscription of 5,000 times or even more than 6,000 times. Okay. So PhillipCapital Management Hong Kong has launched the first and also the only ETF on the Hong Kong EX that tracks IPO companies, those newly listed Hong Kong companies. The fund is also a passive ETF, which aims to fully replicate the selective customized Hong Kong newly listed equities index, which is designed to track the performance of securities recently listed through IPOs or newly listed on the main board of the Hong Kong Stock Exchange based on certain conditions. The index will be rebalanced quarterly, including securities that conducted IPOs or were newly listed within the past 756 trading days, selecting the top 50 securities by free float market capitalization. So companies that are listed more than 756 trading days, which is more or less equivalent to 3 years, will be removed from the index. So all the constituents are companies that are listed within the past 756 trading days. So subject to liquidity and market capitalization standards, the index will include eligible newly listed securities after a monthly review. There will be a monthly review mechanism to admit to add the companies newly listed in the same month. So the index does not need to wait for the quarterly rebalancing to add new constituents, new IPOs. New IPOs will be added actually every month, okay, to the index, and the ETF will also reflect that. So top 10 holdings now comprise Tencent Music, Horizon Robotics, CATL, J&T Global Express, Zhejiang Leap Motor Technology, Media Group, Exterpie Holdings, Giant Baojin Holdings, InnoScience Suzhou Technology, and Wuxi XDC. So you can see it's quite diversified in terms of different industrial sector exposure. The largest part is financials. IT, information technology companies, accounting for 19.3% of the index, followed by this green one, consumer discretionary, 17.5%, and then 12.2% are from communication services, okay, followed by 11.9% from healthcare. So it's quite diversified in terms of different industries. Okay. This Phillip Hong Kong newly listed equity ETF, the stock code is 2835. It was up more than 60% year to date. So it outperformed the Hang Seng Tech Index, okay, which is up around 40%. So it rose from $9 to the $15 lately. So if there's any correction to below $14, $13.5 would be a good entry level for this newly listed equity ETF 2835. Okay, then we move on to stocks. These are the stocks in focus. The first one will be Alibaba. I'll just name 3, 4 positive and negative factors. For some company, there may be more positive factors than negative factors, but for certain companies, there may be more negative than positives. And then we'll also provide resistance and support, price resistance and price support levels to you. Okay, Alibaba's e-commerce and cloud segments are showing robust growth, with cloud revenue accelerating due to surging AI product demand and also partnerships like the recent NVIDIA collaboration. Actually, not only collaborating with NVIDIA, Alibaba is also collaborating with Apple to provide the Apple Intelligence for its iPhone sold in China. Okay, so this will position the company as a leader in China's tech recovery. Okay, analysts maintain a strong buy consensus for Alibaba. On average, forecasting stock price targets around 180 to 192 Hong Kong dollars on average, with potential highs up to $245 amid ongoing share repurchases totaling billions in 2025 to enhance shareholder value. The company's strategic divestitures of non-core assets and focus on AI infrastructure investments will signal improved efficiency and long-term profitability, despite domestic competition in e-commerce and also economic headwinds in China. So Alibaba has seen this new growth engine, which is its AI cloud. Okay, its share price outperformed many others tech companies such as JD.com and Meituan. Okay, so near-term resistance is expected around $200, and key resistance will be around $220. Near-term support is $175. Actually, over the last yesterday and today, you see the share price correct to this level. So for investors who want to get in, $175 would be the first entry level. Key support will be the next key support level will be 155 Hong Kong dollars. Okay. Tencent's resilient gaming business is fueling robust growth, with Q2 revenue surging 15% year-over-year to 184.5 billion yuan, propelled by hits, the evergreen games such as Honor of Kings and Delta Force, alongside enhancements in advertising. Okay, Tencent is also investing aggressively in AI, including proprietary large language models and cloud infrastructure. So now Alibaba and Tencent all has its own LLM model. For Alibaba, it's known as Quen, 通义千问 Quen. Tencent's LLM is known as 混元 3.0. These will position it to capture growing demand for generative AI solutions, with its cloud segment showing 18% year-over-year growth in Q2 2025. Its global gaming portfolio expansion, particularly through Level Infinite and titles like PUBG Mobile, will continue to drive strong international revenue, contributing to a 22% increase in overseas gaming income. Okay, now is very close to the 700 psychological threshold resistance level. So near-term resistance is 700 Hong Kong dollars. Key resistance further up will be around $730. Near-term support is $650, and key support is around 620 Hong Kong dollars. Okay, Kuaishou is another tech companies we like and we are optimistic in. Kuaishou's Q2 4Q2025 results demonstrated robust growth, with revenue surging 13.1% year-over-year to 35 billion yuan, driven by AI integrations like its Kling AI and enhanced e-commerce, with GMV, gross merchandise value, up 17.6%, alongside record daily active users of more than 400 million. Company said its AI video generation model, Kling AI, Keling in Chinese, the monthly revenue has surpassed 100 million yuan now. So it has entered monetized, it has seen monetization, and we expect the monthly revenue to further accelerate future. Despite competitive pressures in China's short video market and regulatory risks, the company's AI-driven efficiencies in content, marketing, and user engagement position it for long-term profitability and market share gains. Okay, so its share price is the rise is less, the angle is less steeper compared to Alibaba and Tencent, and therefore we think it has more upside potential compared to Alibaba and Tencent, which has already risen quite a lot. So now it has it has broken out of the sideways pattern between $70 and $80. Now with our near-term target around 100 Hong Kong dollars, and key resistance further up another 10% up will be 110 Hong Kong dollars. Near-term support will be $81. The upper end of the range, the $70-80 range, previously price range. Another key support level will be 75 Hong Kong dollars. Okay. Xiaomi achieved record revenue of 111.3 billion in first quarter, up 47% year-over-year, driven by strong smartphone shipments, reclaiming the top position in China with an 18.8% market share and improved gross margins reaching 22.8%. But that's up to first quarter. Since the launch of Apple's iPhone 17, it seems that the table has turned. Okay, now it's facing stiff competition from Apple in the third quarter this year, since the launch of iPhone 17 series. Its EV business is showing rapid progress with narrowing losses and a projected path to profitability by end 2025, supported by ecosystem integration from its AIoT Internet of Things strengths and high gross margins of 23.2% in Q1, outperforming rivals like NIO and XPeng. However, it's facing intense competition in the saturated EV market and growing consumer backlash from issues like misleading claims on vehicle features, resulting in refund demands, okay, and also some callback of its vehicles, okay, due to defects being found. Okay, so for the last 1 month or so, you can see the share price actually stagnates between $50 and $60. Okay, so it now is in a sideways pattern between $50 and $60. Near-term resistance is expected around 56.5 Hong Kong dollars, and key resistance is around $61.50, which is the June top. Okay. Near-term support is expected around 52.5 Hong Kong dollars, and key support is $50. Okay, Meituan, which we remain downbeat about. Meituan is one of the tech companies we don't really like for the time being, because it's facing severe headwinds from irrational competition in its core food delivery business, with Q2 profits plunging 98% year-over-year due to aggressive subsidies from rivals like Alibaba's Ele.me and JD.com. leading to warnings of significant losses in the third quarter and prompting analyst downgrades and target price cuts. The company's stock has slumped to a 8-month low amid margin erosion from price wars, rising fixed costs, and regulatory risks over platform fees, and eroding investor confidence despite revenue growth of 11.7% to 91.8 billion yuan in Q2. So for Meituan now is the financial results is the revenue is still growing, okay, by 11.7% in Q2, but you see profit shrinking, profit drop 98% because of severe competition. Okay, while diversification into international markets and new initiatives offer some long-term potential for the company, near-term volatility, uncertain returns from expansions like Kita into Hong Kong and in the Middle East, and ongoing subsidy battles will temper the outlook of the company. Okay, you can see the share price still on a downtrend, and we expect near-term resistance around the 50-day moving average, represented by the blue line around $110, and the key resistance will be the 100-day moving average around 120 Hong Kong dollars. Okay, near-term support is expected around $100, and the key support will be $95, which was its September bottom. Okay, CATL 37, the stock code is 3750. CATL's second quarter earnings showcase record profits with a 34% year-over-year net profit surge to $2.3 billion, driven by strong global EV battery market share expansion to 38.1%. Together with BYD, the two companies account for almost 70% market share of the battery market, EV battery market in China. Okay, and innovations like sodium-ion batteries will help it stand against falling battery prices and also weak EV demand going forward. Robust outlook for its energy storage battery segment, with surging demand driving a projected 25% year-over-year revenue increase in 2025, fueled by global renewable energy adoption. Okay, challenges persist from geopolitical tensions, including U.S. military company listings and potential tariffs on its products, raw material price volatility, and domestic competition eroding margins to 22.41% in the first half, tempering near-term growth into Q3 results due on October 20. So investors who have already who are holding CATL may take note that it will release its Q3 results this month on October 20th. Okay, the share price showed strength recently. You can see rising from below $300 to currently close to $600. Near-term resistance will be around $650, and key resistance is expected at $700. Near-term support is $550. For those who want to enter, a good entry level would be $550, and the key support will be around $500. Okay, NIO and EV, another EV, news outlook remain positive with strong delivery growth, including a 64.1% year-over-year increase to 34,749 vehicles in September 2025. Now it has taken over Li Auto, just behind XPeng and Leapmotor. Okay, for Q3, for the third quarter, it has delivered in total 87,071 units, driven by its multi-brand strategy encompassing premium new models and sub-brands like Onvo and Firefly to capture diverse market sentiments. Okay, different from other EV manufacturers, I think its battery as a service strategy is quite innovative. That means buyers of his cars can rent the battery instead of buying the battery together with the car. Can rent the battery from the company, and so the car will be sold at a lower price, and then the car owner will pay the battery rent to NIO on a monthly basis. So I think this is quite competitive. This makes NIO quite competitive in a sense that its cars, EVs, are sold at a lower price. So in terms of pricing, it's not direct price cuts. It's because the company is charging a battery rental on the owner. So this will also offer recurrent income, generate recurrent income to the company, and also enhance customer loyalty. Customer will be more loyal to its to the NIO brand. Okay, so it plans to expand swap stations to over 4,000 by year end. It's not using the recharging model. It has adopted the battery swap model. So it will be faster compared to battery recharging. Okay, it also is building international swap stations. This will position the company for enhanced customer loyalty and also revenue diversification, recurrent income from battery rental amid rising NEV adoption in China. However, there's some weak point in the company, which is persistent financial challenges, including substantial net losses like $697 million in the second quarter this year, and also high cash burn continue to strain liquidity despite revenue increases. Okay, so its share price outperforms other competitors, rising to close to 60 Hong Kong dollars lately. Okay, near-term resistance is expected around $65 and key resistance at $74. Near-term support is $55 near the 20-day moving average, and key support at $50. Okay. BYD, we are less upbeat on BYD. BYD's outlook in the first quarter is okay, boosted by robust Q1 financials, with revenue surging 36.4% year-over-year to 170.4 billion yuan, and net profit doubling to 9.2 billion yuan, underpinned by its vertical integration in battery technology like the Blade battery and strong BEV sales growth of 31.37% in Q3. Overseas expansion remains a key positive for BYD, with exports up 146.42% year-over-year in Q3 and plans to double sales to over 800,000 units in 2025 through local assembly in markets like Europe to mitigate tariffs, alongside outselling Tesla in regions such as Europe and the Global South. However, since the third quarter, it's facing more headwinds. Domestic challenges are mounting, including the first year-over-year sales decline in September, which is a worrying signal. First time in many years, it show year-over-year sales decline, okay, down 6% compared to the same period last year, and as a result, it has slashed annual sales target from 5.5 million units to 4.6 million units amid intense price wars, oversupply, waning PHEV demand, and also one key policy change. Now the Chinese government requires companies to settle their accounts payable within 60 days. Okay, So BYD used to see its account payable turnover days more than 180 days. It's like receiving zero financing support from its supplier for such long turnover account payable turnover days. But now, since it is required to settle its accounts payable within 60 days, so it has to reduce its output and results in a reduction in the cut in the annual target. Other challenges include geopolitical risks such as EU tariffs of 17% on Chinese EVs and also potential US barriers further erode margins and competitiveness, compounded by high inventory levels and analyst concerns over profitability erosion. So its share price more like Meituan, that of Meituan, still on a downtrend. Now struggling around the 250-day moving average. Near-term resistance is expected around 115 Hong Kong dollars. Key resistance will be around $121, which is where the 100-day average moving average lies. This black line. Okay. Near-term support is 104. Actually, there's the latest low price seen in September. Again, key support will be $100. Hong Kong EX, we like it because of the IPO market and also the actively traded, the market turnover. Hong Kong EX reported its best ever half-yearly revenue and profit in the first half of 2025, driven by record volumes in cash, derivatives, and stock connect markets, alongside a surge in IPO activity that positioned it as the global leader in fundraising. The exchange anticipates sustained strong momentum in the IPO market for the remainder of 2025. It's reported that it has received more than 220 IPO applications. So that would mean a very long IPO pipeline, extending into 2026 or even 2027, potentially exceeding earlier forecasts with over 80 listings raising 250 to 280 billion Hong Kong dollars. So a lot of analysts as well as auditors have revised upward their projection for fundraising, IPO fundraising from below 200 billion to now 250 to 280 billion Hong Kong dollars, fueled by regulatory support, mega IPOs like CATL, and increased international capital inflows. Regarding international capital inflows, we noticed that the Hong Kong EX now is reaching strategic expansions in other areas such as in the Middle East and collaborations with Abu Dhabi Securities Exchange, and in Southeast Asia is also tying up with the Thai exchange. Okay, so as to enhance its global connectivity and also access to more emerging markets. Okay. However, the outlook remains cautiously optimistic. Investors still need to be cautious amid persistent macroeconomic uncertainties, geopolitical tensions, and a decline in net investment income due to falling hypo rates, which could impact profitability in the second half. For Hong Kong EX, because it has a lot of cash holding, and also it take margin requirement from exchange participants are trading derivatives, futures. So the margin it received from the exchange participants, it does not pay any interest to the participants, whereas it will pocket all the credit interest received from those margins it received, okay, from the exchange participants. So if HIBOR goes up, you'll see more investment income, higher investment income due to rising HIBOR rates. On the contrary, if HIBOR rates fall, you will see a decline in net investment income. So going forward, we expect HIBOR rates, because now Hong Kong, the aggregate bank balance has fallen to around 50 billion Hong Kong dollars. So the Hong Kong dollar has weakened, which results in a stronger HIBOR rates, which will be in favor to Hong Kong EX in the near future. Okay, we expect near-term resistance around $460. Actually, from this chart, you can see it has formed a double bottom around $460 so far this year. Whether it's able to break above $460 will remain to be seen. But in terms of valuation, Hong Kong EX is not cheap now. It's our projected EPS for 2025 earning per share is 14 Hong Kong dollars. So divide by 460, the forward PE now is 33 times. Okay, key resistance is expected around $500, which will translate into around 35 times forward PE. Okay, near-term support will be around $420, where the 100-day moving average, you can see here in the chart, the black line, where the 100-day moving average lies. And then further down, the key support will be $400. Okay, $400. Ping An Insurance demonstrated resilient performance in the first half of 2025, with its life and health new business value surging 39.8% year-over-year, and an unannualized comprehensive investment yield of 3.1%, supported by strategic reallocations toward high-yield equities amid a recovering Chinese stock market. The company's integrated finance and health ecosystem continues to drive customer retention, with nearly 63% of its 247 million retail customers accessing health and senior care benefits, positioning it for sustained growth in high-demand sectors like digital insurance and AI-driven services. However, challenges from low interest rates, equity market volatility, so very much like Hong Kong EX, it will benefit from higher interest rates. So low interest rate will be less in favor to Ping An, and also if there's more equity market volatility, and the first quarter it saw a net profit decline of 26.4% due to slumping investment income, highlight ongoing risks in a complex macroeconomic environment, potentially impacting short-term profitability. But now with the A-share market being stable around 3,800 points and 3,900 points, I think the investment income in the second half will be quite stable in the second half. Near-term resistance will be around $55, where the 50-day moving average lies, and key resistance is the $58, the August top of $58. Near-term support is expected at around $51, where the 100-day moving average, the black line, 100-day moving average lies, and key support will be $48. Okay, let's move to some consumer plays. Pop Mart's first half results showcase explosive growth, with revenue surging 204.4% year-over-year to 13.88 billion yuan, driven by the viral Labubu IP from its Monster series, which alone generated 4.81 billion, accounting for more than 30% of the total revenue. Okay, and alongside its 385.6% net profit increase to 4.68 billion yuan, fueled by overseas expansion. The company anticipates full year 2025 revenue of at least 20 billion yuan, with potential to exceed 30 billion yuan, supported by overseas sales projected to surpass domestic figures and rapid store openings in markets like the US and Europe. However, heavy reliance on one IP, the Labubu IP, poses risks as cooling hype in secondary markets and analyst downgrades have led to sharp stock declines recently, erasing nearly $13 billion in value recently amid concerns over unsustainable valuations. There is also concern about regulatory scrutiny on its blind box sales, including state media warnings against excessive spending on mystery toys by teenagers. This will add uncertainty, potentially curbing growth despite Pop Mart's strategies to diversify its IPs and also enter entertainment-like theme parks. But this theme parks venture is also rather risky as another company, the Wanda, now is said to be going under. Once Wanda also planned to build many theme parks in China to match Disney. But ultimately, its theme parks venture failed. So whether Pop Mart's theme parks venture will succeed is still uncertain. Okay, its share price has risen a lot until August, until peaking near 340 Hong Kong dollars in late August, and now is in a downtrend, a correction mode. Okay, near-term resistance is expected at $280. Where the 50-day moving average, the blue line here, lies. And key resistance will be further up at $300. Near-term support is expected at $250 and key support at $230. Okay. Another consumer play, Misha, the bubble tea company, Misha Group reported strong first half 2025 financials, with revenue up 39.3% year-over-year to 14.875 billion yuan, and net profit surging 44.1% to 2.718 billion yuan, fueled by expanded store openings exceeding 53,000 globally and robust sales of low-price ice cream and beverages in lower-tier Chinese markets. So its expansion strategy is quite like Hai Di Lao, the hot pot restaurants, by opening more stores and also expanding overseas. But whether this will prove successful is uncertain now because of more competition from other players. Okay, but it has managed to raise 444 million US dollars through its IPO, Hong Kong IPO in March this year, and also its shares has jumped over 40% on debut. The company is now leveraging proceeds to enhance production capacity and global supply chains, positioning it as the world's largest food and beverage chain by store count, ahead of McDonald's and Starbucks. Okay, overseas expansion into Southeast Asia and plans for entry into markets like the US continue to drive growth through its franchise model and cost-efficient operations, supported by a vertically integrated supply chain that maintains high gross margins around 31.6%. However, investor skepticism persists amid a 15% share slide post-earnings due to concerns over unsustainable growth from delivery subsidies, rising raw material costs, and execution risks in international markets, potentially pressuring margins in a competitive bubble tea sector. So you can see the share price also on a downtrend because of investors' concern about its outlook. It has dropped below $400 lately, so the $400 support level now becomes its near-term resistance, and key resistance is expected at 430, where the 50-day moving average, the blue line, where the blue line lines. Near-term support is around $360, and key support is 330, which is the April low, the low seen in early April this year. Okay, so this ends my presentation today. If you wish to get more update first-hand information about the Hong Kong market, I would recommend you to watch our daily YouTube video, which is known as Market Opening Bell in English. Okay, it comes in 3 different versions, in English, Mandarin, as well as Cantonese. Okay, Mandarin and Cantonese, the title of the video is 开市起跑线, 开市起跑线. You can search on YouTube our videos. Okay, it will be uploaded to the YouTube every morning before 10 in the morning. So you provide some guidelines to the Hong Kong stock market as well as the US market. Okay, what else? Yeah, if possible, do subscribe to Phillip Hong Kong's YouTube channel, our YouTube channel. Okay, let's open to the audience for questions. Can buy fortune REITs, dividend 7%? Yes, the answer is yes. Let me share the price chart. So again, the price chart is the price chart. Okay, so you can see the price chart. This question is about 7 fortune REITs is 778. Okay, yes, the dividend yield is even higher compared to linked REITs, although the size is much smaller. So its dividend yield is more than 7% compared to linked REITs 823. 823, the yield is also quite attractive now, around 6.6 to 6.7%. Okay, because the share price has dropped around more than 10% from a recent high of $45 seen in late July. Another catalyst for both linked REITs and fortune REITs would be the inclusion of REITs, expected inclusion of REITs into the Stock Connect. That will be but this may materialize hopefully in the first half next year because of taxation issues. That explains why it has been delayed until now. Okay, so the yield and also the potential inclusion into Stock Connect, which we may see more mainland Chinese mainland fund flows into the Hong Kong REITs sector. Okay, so for 778, you may buy below $5. You can see there's support around $5. Latest last 1 month's low is $4.98. So around $5 you can make the first entry. If its share price continue to correct to say 480, close to the 100-day moving average, that will be another entry point, 480. Okay, how's the outlook for trip.com? I think 9961 does not benefit from the long-term outlook is bullish, okay, but short term, because of expectation that its share price will respond to the latest labor National Day holiday, the travel will boost its business, yet it does not materialize. So it's some sort of kind of a disappointment, sell off on disappointment in share performance prior to the end of the National Day and Mid-Autumn Festival holiday. But we do expect support around 545 Hong Kong dollars, 50-day moving average. So it has corrected more than 10% from a recent high around $613. So can buy lah. I think around close to $545 or below $550. Okay, how is UbiTech 9880? UbiTech Robotics, yes. You can see the share price rally quite strongly in September until early October because on optimism about humanoid robots, the development of robots, as well as especially humanoid robots in China. Okay, so for investors who are not owning the stock yet, the correction, the current correction may provide good buying opportunities. So one entry point level would be $135 when its price correct further to towards the 20-day moving average, which lies around at $134. So $135, if it corrects to $135, it will also represent 25 more than 10% correction from the recent top of $161. Okay, are there opportunities in healthcare and consumer sector? Yes, we like healthcare because of aging population in China. A lot of there's unmet demand in different types of illness and diseases in China. So let me see the ETF lah. Let me check. Wait, is the China AMC? We'll recommend, instead of buying single stocks, we'll recommend ETF, which is more diversified. AMC. Biotech. I forgot that I need to check. Give me a few seconds. I'll check the stock code. Yeah, 3069. 3069. This is Hang Seng Biotech ETF. Is the fund manager is China AMC, and it's a passive ETF tracking the Hang Seng Biotech Index. Okay, so far this year its share price fare well, but lately it saw some correction. So if share the first entry level would be below $17, between $16.50 and $16.80. That would be the first entry level. Second entry level would be 50-50, $50.50, close to the 100-day moving average. So we would actually suggest this ETF 3069. The stock code is 3069. China AMC Hang Seng Biotech ETF. Your view on Alibaba Health Information 241. Yeah, we expect more demand, and also the monetization or the profit will increase going forward, and the adoption, the penetration rate can continue to rise in China, in demand for online health consultation, and also online medicine drug prescription and drug sales. Okay, but now it's in a correction mode, so investors may wait for the share price to correct. I think it's quite likely that the share price may correct to between $6 and $6.20. So that will be a good entry level for Ali Health. Okay, so the company, yes, together with 6618, the share price also fare well so far this year, but now is forming a top pattern lately, and we expect some correction in the midterm. Okay, another one is 1833, also in a correction mode. Okay, so 241, you may wait for the share price to correct to between $6 and $6.20 before going in. Updates of growth in Chinese banks. Just now I saw, yeah, I think Chinese bank lately no catalyst lah, but the high dividend yield will lend support to the share price. The four state-owned banks are still on a downtrend. You see CCB corrected more than 10% from $8.56 to current $7.31. Likewise, 1398 ICBC also dropped by more than 10% from $6.40 to $5.65. ABC dropped less, around 10%. So our call for the Chinese banks is, in the midterm, there's no imminent catalyst, but the dividend yield, now you can see here, 939 is yielding 5.9% dividend yield. ICBC also 5.9%, close to 6% dividend yield. ABC lower because its share price is more resilient. Instead of a lower dividend yield, we still think ABC is the top choice, is a top pick among the four state-owned banks, because in for the first half you can see the financial results. The remaining three state-owned banks all show drops in revenue as well as net profit attributable to shareholders. You can see net profit attributable to shareholders show positive growth, at least in the first half this year, compared to Bank of China, CCB, and ICBC, all posting drops in. CCB first half profit dropped 1.4%. Okay, ICBC dropped even more. I remember 2%. I think more than 2%. Similar 1.4% for ICBC and CCB, and 3988 Bank of China is net profit better, increased 2.4%. So I think among the four state-owned banks, ABC and 3988 are the two top picks. Okay, 3988 it may be testing the support of the 250 day moving average at 415 dollars, $4.15. So if it breaches the support of the 250 moving average, a good entry level would be between $4 and $4.05. $4 and $4.05. As for 1288 ABC, good entry level will be around $5, close to $5. Okay, what about China Fusion Energy? Fusion Energy, the they are just neutral. Our view on because on the one hand, the economic slowdown currently will also represent a weakening demand for electricity in the short term. But in the mid to long term, because this AI will drive demand for electricity, will drive electricity demand, but it may be seen not in the near future. It may be seen in 2-3 years time. So in the midterm, power companies you can see a few power companies, they're just moving sideways currently. This is Huadian Power, this is CR, China Resource Power, Huaneng. They are moving sideways because of the weakening demand for electricity due to the economic slowdown. Okay, Hua Hong Semiconductors, yes, its share price has risen, wow, very strongly because of the belief that replacement by domestic chips will accelerate in the near term, and also driven by AI. Homegrown AI models will also fuel the demand for domestically produced chips. So the two beneficiaries will be Hua Hong as well as SMIC. But now I think it's a bit pricey. So wait lah, if its share price corrects to at least $80, closer to the 10-day moving average, will be a good entry level. Now it's oversold. You can see the 9-day moving, the 9-day RSI, 9-day relative strength index is now at 92.5, which means the share price very overbought for the time being. So if those investors wish to get in, we'll recommend to wait until the share price correct to around $80. Okay. Any thoughts of Jijin Gold 2259? 2259 is the international business unit under Zijin 2899, recently being spun off. But first of all, both Zijin Gold International 2259 and 2899 Zijin Mining benefit from the recent rally in gold price, which has surpassed $4,000 per ounce. Investment banks are now still very upbeat about the outlook of gold. We do think gold is able to rise further to about 4,300 to between 4,300 and 4,500 in the midterm, supported by a few positive factors, namely this geopolitical tensions, economic uncertainties, steady central bank buying, and also inflows into gold ETFs and a weaker US dollar. These tailwinds will continue to support gold prices. But between Zijin 2899 and Zijin International. I think the parent company is more attractive. You can look at this is the price, the PE. Now it's trading on 27 times historical PE and 19 times forward PE, whereas 2259, sorry, 2259, the market cap is trading at about 30 times historical PE, because now its market cap is 377 billion, and in May last year it made 481 million US dollar. So in Hong Kong dollar, if you convert to Hong Kong dollar, it would be 375. Let me see. Now it's 375 30. Let me see. 4亿8100万 37亿 is 3.75 billion Hong Kong dollars, compared with the market cap of is 100 times PE lor. Okay. So 28, the parent company would be better. The parent company would be better. Okay. Could please share your view on Beijing Jingneng Clean Energy, Great Wall Motor, CK Infrastructure? Okay. 579 Jingneng. Its financials it has sound financials last year as well as the first half of this year. Again, stable lah, I would say. In the first half of this year, its revenue grew by 2.9%, whereas net profit attributable to shareholder remains stable around close to 2 billion yuan, down only 5%. Okay. So full year earnings is expected to grow from 3.2 billion yuan last year to close to 4 billion yuan expected earning net profit this year. So the share price, but yes, currently all power companies now are moving sideways. As I have shown earlier, CR, China Resources Power, this is China Longyuan. They are in a sideways pattern. So 579, we expect the share price to remain sideways in a sideways pattern between 235 to $2.60. If there's any breakout above $2.60, then you may see a higher target of $2.80. Okay. The company, in terms of valuation, it still looks good, because now it's trading at around 6 times historical PE and 6% dividend yield. Very attractive, I would say. Okay, very defensive as well. Okay, the other one is Great Wall. Okay, Great Wall may be facing more competition from the so-called new forces, such as Leap Motor, Neo, Xpeng, as well as Leap Motor, Li Auto, and then also from the other traditional car makers, it's also facing competition from Geely and Chery, which is lately listed in Hong Kong. So the share price, we expect further correction after topping, meeting resistance, failing to break above $20. So if the share price drop below $16, the $16 support, it may test the $15 next support level at $15, close to the 100-day moving average, which lies at $14.50 lately. So Great Wall, we are neutral. Because it's facing competition from both the new forces and also the traditional automakers. Okay. Hong Kong CKI. The yield now is not particularly attractive, 5%. You may have many other options, other stocks to choose from that yield 5% or even more. So the share price, I think in the near term, there's no catalyst. We expect the share price to remain sideways, range bound between $50 and $55. You can trade, do range trading between $50 and $55. Okay. Please comment on XtelPi. Yes, we like this company because it is AI deploying AI on biopharmaceutical development. Okay, so it will ride on the AI trend. Okay, 2228. But recently its share price has risen quite a lot, and also has conducted, if I remember correctly, share placement recently. Yeah, it just done a share placement in early September, placing out 285 million shares at $9.28. So after the share placement, after rising to $15, I think it is due for a correction. Okay, it may if the next support level would be $12, where the 20-day moving average lies. But in view of the sharp rally in the last 2 months, I think the share price may correct further down to say $11. For those who have not owned the companies yet, a good entry level would, I will suggest to wait for the share price to correct to $11 before going in. Okay, but basic fundamental is good because of the AI outlook. Okay, can share on 981 SMIC. Our view is similar to Hua Hong Semiconductor. It will benefit from higher utilization rate, which will translate into higher gross profit margin, as there will be more demand from homegrown AI LLMs. But now the share price is due for correction. We'll suggest investors to wait for the share price to drop to below $80. Say, for instance, $78 to $79. That would be a good entry level if its share price corrects to between $78 and $79, because it meet resistance around $93 as shown in the price chart. Okay. Okay, a few last stocks. 968 and 1951. 968 is recovering. Okay, the whole solar sector is recovering. So you see the prices of solar panel as well as solar glass are recovering. So it's on a gradual uptrend. Okay, we expect this recovery to at least continue until the first half next year, because of anti competition, anti price competition. Okay, so the next target is in an uptrend. You can see in a upward channel. The next target will be $4.15 based on the current uptrend. Okay, 1591 was one. Oh dear, was the other one? I missed that. Let me see. Oh, seem to have missed. Which are the bank's counters still worthwhile to consider? Oh, just the latest news. For those who are holding HSBC and Hang Seng, today HSBC announced a privatization offer for Hang Seng Bank, which it already owned 62%. For the rest, so it will offer $155 cash offer per Hang Seng Bank stock to privatize Hang Seng Bank. Because of this 155 privatization offer price represent a 30% premium to Hang Seng's closing price yesterday at $119. So today, Hang Seng Bank soared 26.5% to $150.60. Okay, the privatization offer is 155. Since this represents 1.8 times price book value on Hang Seng, I think the chance for this privatization to go through will be very high. Okay, because if there is 75% voting for from his the shareholders, holding the 36 remaining outstanding shares, and not more than 10% rejecting the privatization, the privatization will go through. But we think for investors who are holding Hang Seng, actually we suggest them to sell Hang Seng at this price level. You don't need to wait for the privatization, because the privatization is expected to complete in the first half next year. I mean, you may need to wait for more than 6 months to get the $155 offer, which is only 3% higher than the current market price. So investors who are holding Hang Seng Bank may sell Hang Seng Bank in the secondary market, in the cash market, and then we suggest buying HSBC because HSBC now is the dividend yield is 5% compared to Hang Seng only 4.6%. So and because of this privatization, and also HSBC, because he has to pay to the shareholders of HSBC, the minority shareholders, more than 100 billion Hong Kong dollars from his reserve. So for the next 3 quarters, will stop from share purchase, which will be negative to the share price. So any weakness in HSBC in the next 3 quarters would be actually a good opportunity to buy HSBC if there's any further correction, say to below $100, say $98, 100-day moving average. Okay, so to answer the question, HSBC, beside the state-owned banks which are yielding more than 5%, HSBC, because of this privatization offer, it also provides an opportunity because all along you can see this before this privatization offer, its share price keeps going up. It's very difficult to find good entry points. But now this provides an opportunity to buy HSBC maybe below $100 at $98. So now we are reaching 2 o'clock. I think I regret I cannot answer all the questions. Hopefully I have answered most of the key questions raised by the audience. Now let's go back to the anchor. Thanks.
Thank you, Louis. Yeah, I think that's all for the questions for today. Yeah, thanks again for the presentation and the Q&A. So we have come to the end of the webinar today, and we would like to thank all of you for joining. Yeah, please kindly fill in our feedback form so we can improve your experience with us in the future. And this webinar will be recorded and uploaded in our PhillipCapital YouTube channel. Once again, thank you for joining, and we hope to see you again. Stay tuned, take care, and have a nice day.